So imagine a blue chip stock, right, that's just crossed below its 200-day moving average.
Which is, usually bad news.
Right, it's usually a classic bearish signal. But prediction market traders right now are locking in a 75.5% probability of an earnings beat tomorrow.
Yeah, it's wild.
And that stock is Walmart. So today we're doing a deep dive into exactly how they've engineered this setup ahead of their August 2020 earnings report. But before we jump into the details, just a quick disclaimer.
Right, always important to mention.
Yes, this deep dive is for educational purposes only. It is not financial advice, and neither of us are licensed advisors.
Exactly. But it really is a fascinating setup we have here. The core mystery we're unpacking today is how this legacy big box retailer is quietly restructuring itself to operate and, well, be valued like a high-growth tech platform.
Right, and to understand that, we have to look at the reality on the street right now. I mean, national gas prices are sitting near $4.08 a gallon,
Yeah.
and inflation is just stubborn. People's wallets are totally squeezed, and yet Walmart actually grew its transaction volume by 3.0% in Q1.
Which is huge.
Yeah, they aren't just raising prices to fake their growth. They're physically getting more people through their doors.
Exactly. And it really comes down to what they sell. I mean, 60% of Walmart's U.S. sales come from groceries.
Right.
You have to buy food, regardless of what gas costs. So they're using that massive everyday grocery footprint to just organically capture market share from competitors.
Which makes sense.
Yeah, and you can contrast that with Target. Target just posted 3 straight quarters of declining sales.
3/4.
Yeah, and why? Because grocery is a much smaller fraction of their business. They rely heavily on discretionary items, things like clothes, electronics, home decor.
And when household budgets tighten, those are like the very first things shoppers cut.
Exactly.
So I guess I like to think of it like an anchor in a sail. Walmart's grocery dominance is this heavy anchor keeping the ship steady in a storm, while Target is, well, they're relying on discretionary sales, basically.
That's a great way to put it. And the market sees it too. I mean, Walmart commands a premium, like a roughly 40x PE ratio.
Oh, wow.
Yeah, compared to Target's roughly 21x.
Okay, so groceries are essentially their loss leader. It's the foot traffic engine. It's exactly like a movie theater, right? You come in for the cheap movie ticket, the groceries, but the theater actually makes all its profit selling you the overpriced popcorn.
Right.
So what is Walmart's popcorn in this scenario? Like, where are they making the real money?
Well, their popcorn consists of 3 high-margin engines. You've got e-commerce, membership fees, and advertising.
Okay.
Let's just look at the ad business. Their global platform, Walmart Connect, grew 37%. And they recently bolstered that whole ecosystem by acquiring the Vizio Smart TV platform for $2.3 billion.
Wait, hold on. How does buying a TV company help a grocery store sell more ads?
It creates what the industry calls closed-loop targeting.
Okay.
It means Walmart can show you an advertisement for a new shampoo on your Vizio TV in your living room. And because you're in their digital ecosystem, they can track if you actually walked into their store and bought that exact shampoo the next day.
Oh, wow. That is clever.
Yeah, it absolutely proves to advertisers that their money is working. And then you add that to the recurring revenue from their roughly 30 million paid Walmart Plus members.
Right.
And suddenly they aren't just making pennies on bread, they're generating tech company margins.
Okay, well, if they are transforming into this high-margin tech giant, I have a massive red flag to throw on the play here.
Oh, what is it?
In Q1, Walmart's free cash flow plunged to a negative $1.9 billion.
Yeah, it did.
I mean, you do not usually see a supposedly safe stock burn almost $2 billion in cash in a single quarter. Like, why isn't Wall Street panicking about that?
Because that cash burn is entirely deliberate. They are projecting to spend a staggering $24.5 billion to $25.0 billion in capital expenditure for FY27.
Wait, $25 billion on what?
Well, they are just painting stores. They are fundamentally retrofitting 23 of their 42 regional distribution centers
Okay. With what exactly?
with advanced robotics and automated sorting systems.
What does that actually look like in practice? How does it change things?
Well, instead of humans walking miles down warehouse aisles to find products, massive robotic systems retrieve items and bring them directly to a central packing station.
Oh, so it speeds everything up.
Tremendously. It completely changes the math on delivery. Because of this, 35% of all store-fulfilled e-commerce orders are now hitting customers' doorsteps in under 3 hours.
Under 3 hours.
Yes. They are essentially building a proprietary Amazon Prime-style logistics network hidden inside the footprint of your local grocery store.
That is wild.
And the market trusts this negative cash flow because this exact kind of heavy spending already proved itself. It yielded over $14 billion in free cash flow last year.
Okay, so they take a short-term cash hit to build a long-term automated moat. I get it. So if you had to put a verdict on this structural transformation ahead of tomorrow's earnings, how do you score it?
From an operational standpoint, I'd give this setup an 8.5 out of 10.
Okay, 8.5.
Yeah, the reasoning is pretty clear. They've successfully insulated themselves against consumer stress through their grocery dominance, while simultaneously laying the groundwork for high-margin platform revenue.
Right. So what keeps it from a 10?
The only thing keeping it from a perfect 10 is the execution risk. I mean, if the robotics integration across those 23 centers stumbles, that $25 billion cash burn becomes a very real problem.
That makes total sense. I mean, if you've noticed more third-party brands on the Walmart app lately, or wonder why your deliveries are arriving crazy fast, this automated machine is exactly why.
Yeah. And that leads to one final thought to keep an eye on.
What's that?
To feed this massive new automated network, Walmart has introduced strict new supplier logistics rules, things like their prepaid consolidation program. They're essentially forcing outside brands to surrender their first-mile shipping control over to Walmart's internal logistics network.
Oh, interesting.
Yeah, so as Walmart tightens this grip to optimize its own fulfillment, we really have to ask, is their ecosystem quietly becoming just as unavoidable and restrictive as Amazon's?
That is a fascinating question and definitely something for us to watch.